Do you guys have any questions so far? So neutrally or aggressively. Aggressively means when it's a strong momentum market, strong bullish market, trending market. I mean, everyday prices are moving up. Then you can get aggressively long at demand areas, at any demand area. Neutrally means you are looking at a proper pullback to a good demand zone which is coinciding with a higher time frame. I mean, the stock is currently trending down on the smaller time frame, but overall time frame it's trending up. That's being neutrally bullish. You wait for the turn to happen. Whereas aggressively bullish means it's an uptrending market, everything is fine, momentum is strong, just get bullish or bearish, whatever it is. Mimicking means creating a similar position with options. So when you buy a script, you have to put in all the money, right? So you buy a script because you expect it to go up, but the same thing can be mimicked by using options. Vijay. Okay. Now considerations while when trading options. Core strategy. So this is the first thing. You need to be very well versed with core strategy. That is supply and demand. Yes, you can do, Arun. Whether you own or not own the underlying has nothing to do with whether you can buy or sell options. Core strategy has to be perfect. We trade options the same way we trade scripts by using Online Trading Academy's core strategy to define direction or lack of direction. So first what you do is you go to the underlying and figure out what is the underlying doing. Is it trending up, trending down, non-directional? Where are my demand zones? Where are my supply zones? Everything you do with core strategy. Now, let's say you have a buying opportunity in the underlying. So instead of buying the underlying script, you use options as a substitute for the script. So instead of trading the script, or buying or selling the script, what you do is you trade the underlying, you trade the options for the underlying. We speculate that the value of that option, that is the right that you own, will go up or down based on an analysis, and therefore we trade these contract instead of shares of the script. So once you analyze the underlying, we know that the underlying is going to move up. Let's say we buy a call option. Why do we buy a call option? Because we expect the call option to go up in premium, and once it goes up in premium, thereby we will have our profits with us. Volatility analysis and strategy selection. Since options change their price not only based on the price of the script changing, a deeper analysis needs to be made to decide the optimal option strategy to be used. What is the other thing that we know? Options prices are affected because of the underlying people's expectation of the underlying price movement. Right now, as of now, we have only learned two things, right? One is that options price move because of the underlying price movement, and second is because of people's expectation. So we are talking about the second option here, that is a people's expectation. Since options change their price not only based on the price of the underlying changing, a deeper analysis needs to be made to decide the optimal option strategy to be used, depending on how people's expectations are. If people are expecting too much or too less or too little or too much, in that scenario, we'll have to change our option strategy. All right. Any questions before we go for a break? No? All right, perfect. So let's take a 15 minutes break, come back and then go straight to lunch. That's when we are going to get into more of terminologies. All right. हाउ टू फाइंड एक्सपेक्टेशंस कल पता चलेगा रमेश जी, सब बताऊंगा, डोंट वरी, आई एम गोइंग टू टेल यू एवरीथिंग, जस्ट दैट यू नीड टू हैव पेशेंस. Right? No log out, no log out. No, this is not a lunch break, this is a regular break, tea break. Log out will be only at 1 o'clock. Right now, just stay put in the session. Let me just show you that thing. Put it here. Again, for those who don't hear it, it's disconnecting. Okay, no idea. Let me check your internet connectivity. Sushila, your internet connectivity is fine. Let's see. Bhavya seems to have dropped out. Okay, let's go ahead. Underlying asset, instrument that the option price is established from or derived from. Like in this case, it was the flat. In the case of stocks, it will be those individual stocks. Derivative, since options derive their price from the underlying asset, options are also referred to as derivatives. Okay, because they derive their prices from the underlying. Underlying equity refers to size. Size depends on the contract itself. Example, Reliance. So Reliance has a contract size of how much? 500 shares. Okay, like Tata Power will have a contract size of 9,000. Index is always cash settled. Nifty 50, Bank Nifty are the indices. ETF size depends on the contract itself. Gold Bs, Nifty Bs, Bank Bs, but these are not optionable currently in the Indian scenario. Commodity, futures contract, physical delivery, oil, gold, all those commodity products. Futures contract, Nifty 50 futures. Forex, cash settled, again USD INR. Everything is cash settled. Now, in this class, we'll be focusing on equity options, but the same methodology will be applied to all the different asset classes. Strike price, the specific price that defines the value to be exchanged in the options trade. So, in the case of our flat example, what was that specific price? Can anybody tell me? 1.5 CR, absolutely correct. Premium. In the case of the ITC example, what was the strike price? 300. Absolutely correct. Premium, a mutual exchange of payment, the price an option buyer pays and the amount an option seller receives. In our flat example, what was the premium? 3 lakhs. Expiry date, the certain date that the options contract is finished or completed. What is that date? Whatever. In our example, it was 3 months from now. That is 30th April. Yeah, so it could be last. It depends on the contract, Anand, that you've chosen. You could have chosen the front month, the far month, whichever contract you have chosen. Now let's come to exercise. What is exercise? When a buyer, no, minimum is 1 month, and in case of Nifty and Bank Nifty, it is 1 week. Now, when a buyer pays the seller a premium and the option is converted into an underlying position, that is a script position, that is what is called as exercise. So what does a call option give you, by the way? Right to buy the underlying, right? So when you convert that right, the process of converting that right into the underlying asset is what is called as exercise. Got the point? The process of converting the right into the actual asset. So when Sony pays Shashank 1.5 CR and takes the flat in her possession, that process is called as exercise. Sony is exercising her right to buy the underlying because she owned the right. Clear? Is the exercise definition clear to everyone? All right, Bhavan. Now, Mr. Park says that is to comp contract. What is comp contract? Complete, yeah. Now, exercise. Now, options are two types depending on the exercise that can be done. One is the American style, the other one is the European style. In the American style, the exercise can be done any time on or before end of its life. Let's say Sony had the right to buy the flat up to 30th April. So Sony can decide any day after till 30th April that she wants to complete the exercise. Any day. That is what is an American option. The moment you own the option, you can exercise your right. That's American option. Whereas in the case of European option, the exercise process can only be done at the end of its life. That is on the day that it expires, the contract, which is on 30th April. So if the option that Sony had was a European option, the on the 30th April only in the evening when the options will expire, that is the only time when Sony can tell Shashank that now take this 1.5 CR and give me my flat. This is European option. And in the case of American option, she can do this anytime. She does not have to wait till 30th April. Understand the difference between American options and European options? In India, earlier we had both American and European, but right now we only have European options. We no longer have American options. You can trade the contracts, But the underlying owning can only be decided based on whether you have an American style or a European style. But the contracts can be traded anytime. Just waiting, Sushila is typing something. What happens if it is not squared off? So if it's whatever, in the end it is going to get exercised. Sushila, American style means if you, let's say, own an American call option for Apple. Let's say Apple right now is trading at about 160 odd level or $170, and you own a 170 American option, then you can exercise your right anytime. As soon as you buy the option, you can exercise the right anytime. You don't have to wait till expire. Whereas in the case of European, you can exercise only at the end of life. That is the expiry day. Simplest difference is European style exercise can be done only on the last day of expiry. Yeah, don't trade American. Europe, US will probably have both American as well as European style. European is not risky. American is risky. So usually, traders, those who are options traders, no, exercise is not by paying premium. Exercise is by paying the total value of the underlying and accepting the delivery of the shares. Yes, 1.5 CR in our example. You pay 1.5 CR and then take charge of the flat. So in US, the option traders will primarily be trading the European options and not the American options. You will trade American options when only the intention is to buy or sell the underlying. Yes, if not buy, buyers will decide when to do it. If you sell, it is dangerous, Sushila. Selling of American options is dangerous. Buying still the right is with you, right? Anytime you can decide. All right. So the buyer will exercise, the option buyer will always exercise the right. No, there's nothing to do with expensive or this. That depends on the market condition and the underlying price. But yes, you're right. To an extent, the sellers will govern the price here. Yeah, the sellers will the price. All conditions being equal, then in that case, yes, American options will be tad expensive compared to European options. So the buyer always has the exercise right. If the buyer exercises his right, the seller will automatically get assigned. Assignment is nothing but the risk of the options contract converting to an actual underlying position that is taken by the seller. So if I buy, when Sony buys the call option from Shashank, okay, when Sony buys the call option from Shashank, isn't Shashank at risk? What if the underlying price rises up? So who's at risk, Shashank or Sony? The option seller. In this case, it is Shashank. Okay. So the risk of the options contract converting to an actual underlying position that is taken by the seller, that process is called as assignment process. Is exercise and assignment clear to you? Alright. Now contracting parties. Why the word risk? Remember Anand, when Shashank had got into the agreement with Sony, the agreement value was 1.5 CR. But can the flat price increase during the life of the assignment, the life of the contract? So whatever increase happens, isn't that the loss for Shashank? That's a risk which is being borne by Shashank. Sony is not at risk. Sony's risk is limited to 3 lakhs. Option buyer has the right to exercise. Option buyer has the right to exercise converting the option into an actual underlying asset position by paying the seller a premium. So here Sony has the right, because she's bought the option from Shashank, she has the right to exercise converting the option into the underlying flat position by paying the seller a premium. So she's paid 3 lakhs to own the right. That's what the option buyer has. The buyer has the right to exercise his option at expiry in case of European options, and in case of American options it will be any time. Yes, Sushila. Option seller, also called as option writer. Seller and writer is the same terminology that is used interchangeably. The option seller has the obligation of assignment of the underlying expiration at expiration. So Shashank will be obligated if Sony wants to own the flat. He cannot refuse that to Sony. The seller assumes the risk of the movement of the underlying in exchange for receiving a premium. So you will say, right, the seller has too many risks. So why to be a seller? Why not just be a buyer? We have limited risk. A buyer will always have risk limited up to what point? The premium paid. Correct. Whereas the seller will have to assume the risk, which is unlimited, right? The underlying, the flat can be priced at 3 crores later on. So who's losing it here? The buyer of the contract or the seller of the contract? The seller. To be seller only if you have physical stock. That's the concept, Suresh. That's at a conceptual level. In practical, we are going to be traders. We are not interested in owning the underlying or selling the underlying. We are only interested in trading the premium. Both these are mirrored positions. What the buyer gains, the seller loses. So if the flat, underlying flat, which was currently valued at 1.5 cr moves to 2 cr, what is Sony's gain? 50 lakh. And what is Shashank's loss? 50 lakh. So whatever the buyer gains, the seller loses. Whatever the seller gains, the buyer loses. They always begin at the same starting point. So that's why they are called as mirrored positions. Is this clear? Exercise is a process which only the buyer can do. Assignment happens once the buyer exercises his right, the seller gets assigned automatically. How can a buyer assign himself? The buyer can only exercise his right to buy or sell the underlying. So when he exercises his right, the seller automatically is obligated to do it, right? So he automatically gets assigned. In India, we don't exercise, Amit. In India, exercise is not possible. It's all cash settled. Whatever difference is there, you get paid for that. But now, for a list of about 50 odd stocks, this process has been started in India. The list of those 50 stocks, you will get it on NSE website. So some of the stocks are Adani Power, Ajanta Pharma, Andhra Bank, BEML, Berger Paint, Canfin Home, CG Power, NIT Tech, MRPL, KPIT, IDBI, Hexaware, Granules, Chennai Petro, Wockhardt Pharma, Arcom, R Power, Siemens. These are some of the stocks where exercise and assignment is possible in India. It's newly introduced. Now, okay, Renuka, you have any question? Yes, Chandrasekhar. What, who gets advantage of this? How is it going to affect the option traders? It's not going to affect. Option traders are going to only trade the premium rise from 3 lakhs to 30 lakhs. That's it. He's not interested in the inter. Who gets advantage? No, whoever is. So it depends on your supply demand equation, Sushila. So if you are a good supply demand trader, you will know. You will get actual share. Yes, Girish. In those 50 stocks, you will get those actual shares. Now there are only two types of options: call option and put option. Let's talk about some correlations. Okay, what is positively correlated and what is negatively correlated? What do you mean by this term positive correlation? Anyone? Deepa says rise. Yeah, something that moves in tandem, right? Positive correlation means it is moving Okay. A positive correlation means an option gains value as the market or the underlying gains value, or the options lose value when the underlying loses value. So they both move hand in hand. So imagine just do this what I'm telling you to do. Hold your two palms facing upwards in front of you. Okay, hold two palms facing upwards in front of you. The left palm is the underlying stock and the right palm is the option, call option, let's say. Okay, underlying and right palm is your option. Now when your left hand moves up, your right hand will also move up. When your left hand moves down, your right hand also moves down. This is positive correlation. Both of them move up or down together. That is what is called as positive correlation. And call options are always positively correlated, which means as the underlying goes up, your call premium will go up. As the underlying goes down, your call premium will also go down. That is what is positive correlation. What is negative correlation? An option gains value as the market loses value. An option loses value when the underlying gains value. So if you again take the two palms, the left one is your underlying, the right one is your options premium. If your left hand goes up, your right hand comes down. If your left hand goes down, your right hand comes up. This is inverse correlation, isn't it? Or negative correlation, and that is nothing but a put option. A put option gains value as the market loses value, and a put option loses value when the market gains value. Why would it be negatively correlated? That is how they are defined. Okay, only two options we have, a call option and a put option. Call is positively correlated to the underlying, put is negatively correlated to the underlying. Yeah, this is their basic inherent property. You can't change them. Any questions, guys, on positive correlation and negative correlation? But how the price of share go up and premium goes down? What's the scenario and reason? That is the inherent characteristics. Inherent characteristics, Venkatesh, cannot be changed. For negative correlation, simple example. If Nifty goes up, let's say Nifty is trading at 672 now, and we're talking about 10,700 put option, which is right now, let's say, valued at 100 rupees. If Nifty moves to 10,800, what do you think the put value will happen to the put value? Go down. That is negative correlation. All right. Okay, perfect. Let's go ahead now. Now, call options. A market participant can buy or sell a call option. Do you agree with that? You can buy or sell a call option. Yes, call is always positively correlated, put is always negatively correlated. That's the inherent characteristics. Like, yes, it's just like a man is a man. That's it. You can't change him. A woman is a woman. That's in inherent characteristics. Any other question? I see a lot of people are typing. Let me just wait. In our example, if the flat price goes up, the premium should no, in our flat example it is the same thing. If underlying goes up, your premium will go up. If the underlying goes down, your premium will go down. There is not no inversion here, Venkatesh. Whether to buy a call or sell a call, we still haven't come to that funny, Renuka. You can sell a call option. अरे जब तुम लोग बाय करते हो तो कोई ना कोई तुमको सेल करना पड़ेगा ना वो कॉल ऑप्शन पार्थ. When somebody sells you, then only you can buy it, right? So you can either buy a call option or sell a call option. Both actions you are allowed to do. ऐसा कोई restriction नहीं है कि तुमको सिर्फ call option ही buy करने का है. Call sell नहीं कर सकते तुम. Okay. So you can either buy a call option or you can either sell a call option. Either of these things can be done by you. Buying of a call option is to call away shares from the seller. So when you buy the call option, what do you own? Do you own a right? When you buy a call option, what do you have? You have the right to buy the underlying. Right to buy the underlying means you can go and call the shares away from the option seller, the call seller. Whereas when you sell a call option, shares to be called away by the buyer. You have the obligation for the shares to be called away from you. Remember, call buyer has the right to buy the underlying. Call seller has the obligation to sell the underlying. So if you sell a call, you will be obligated for the shares to be sold by you. And if you are a call buyer, you have the right to own the shares and take it from the call seller. The right but not the obligation. So when you buy a call option, you always will have the right and not the obligation. The right, what is that right? The right is to buy a fixed number of underlying securities at a specific price on or before a specific date. So for example, Sony has the right to buy one flat at a price of 1.5 CR on or before 30th April. Got it? Yes, Pudupet, you are absolutely correct. Yes, Amit. For every buyer, there has to be a seller. So, and it is oranges to oranges, okay, not oranges and apples. मतलब तुम कॉल बाय कर रहे हो, मतलब सामने वाला पुट नहीं सेल कर रहा है तुमको. See, you have to embrace risk here. You have decided to become a trader, so risk is going to be with you forever. So you got to be friends with risk. You got to manage risk. Yes, Chandra, you're absolutely right. Most professional option traders prefer writing options over buying. There are reasons for that. We'll cover once you understand Greeks. Yep, this is what you're going to learn. Yes, so when Rahul Mathur buys the call, Ramesh Dharamlingam has sold the call. Yes, writing means selling, nothing in one and the same. जैसे आप लोग फ्यूचर्स कॉन्ट्रैक्ट बाय करते हो, फ्यूचर्स कॉन्ट्रैक्ट में आपको कोई दिक्कत है या समझने में? क्या करते हो? लेट्स से यू वांट टू बाय निफ्टी फ्यूचर्स राइट नाउ. आई थिंक निफ्टी इज गोइंग टू गो अप. So then you want to buy Nifty futures. So what would you do? You put a bid. I want to buy Nifty futures at a price of, let's say, 10,710 rupees. So you bid and wait for somebody to come and sell it to you. When somebody comes and sells it to you at 10,710, that means you are in the trade. That is only when you are going to be in a position, right? Similarly, it's in the option. So if you want to buy a call option, you also need to find a call seller. So you bid, I want to this call at X rupees. So if somebody is willing to sell at X rupees, that's it. That is when the trade will get executed. Any questions on this? Puru is typing, Ashish is typing. Ashish and Puru, do you have any questions? No, 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 Rahul. They are two different things. They exist together, but they are not related to each other. Yes, you will always be buying and selling at limit prices only. Yes, absolutely correct. It's just the same. You, instead of stocks or futures, you are using options contract. All right, let's go ahead. What's the result if we buy and sell the stock at the same price, same strike price? But stock कैसे buy? Strike price और stock का कोई संबंध नहीं है, Chandra. So either you buy a call option or you sell a call option, right? No, Prasanna. अरे क्या रुक जा. Prasanna says for every buy call there are two sellers. Who said there are two sellers? Did I tell you that? Why do you assume that? I told you, right? A call and a put is different. Calls are primarily bullish instruments, puts are primarily bearish instruments. But you can create a bullish and a bearish version both by using calls. You can create a bullish and a bearish version both by creating by using put options. They are totally two different. When you want to buy a call, you will always find a call seller and not a put seller or a put buyer. Please try to understand they are two different instruments. Call is primarily if you are bullish, put is primarily if you are bearish as a buyer of the option. Absolutely correct, Pranab. For every strike price, so for a particular price, so it's a contract that you get into with someone, right? So let's say, for example, you let's take the same example of Sony and Shashank. Now Sony wants to buy the flat. Will Shashank sell her a bungalow? सोनी ने जब कॉल फ्लैट के लिए कॉल ऑप्शन खरीदा है तो उसको बंगला थोड़ी मिलने वाला है रिटर्न में. फ्लैट ही मिलने वाला है ना, अपार्टमेंट ही मिलने वाला है ना. तो कॉल बाय करोगे तो पुट कैसे चेंज होगा? कॉल वोंट चेंज इनटू पुट और पुट वोंट चेंज इनटू कॉल. टू डिफरेंट थिंग्स. Yeah, here are two sellers. So Prasanna, you can choose to be a call seller or a put buyer. You can't do both. Call buyer pays premium, Suresh ji. Call seller gets premium. सो प्रसन्ना, अगर आपको बुलिश पोजीशन क्रिएट करना है तो बुलिश पोजीशन क्रिएट करने के लिए या तो आप कॉल बाय करो विच इज अ बुलिश पोजीशन, और या पुट सेल करो विच इज अगेन अ बुलिश पोजीशन. रिमेंबर, व्हेन यू ट्रेड विथ अनदर पर्सन, बोथ ऑफ यू विल यू हैव द सेम व्यू और द ऑपोजिंग व्यू? लेट्स से मैंने आज टाटा मोटर्स खरीद लिया, तो जो मुझे टाटा मोटर्स बेच रहा है वो सोच रहा है कि स्टॉक नीचे जाएगा, इजंट इट? इसलिए वो बेच रहा है, और मैं समझ रहा हूं कि स्टॉक ऊपर जाएगा इसलिए मैं खरीद रहा हूं. सो इज आर व्यूज टोटली ऑपोजिट? So a call buyer thinks that the underlying is going to move up, whereas a call seller expects the underlying to remain lower itself. It won't move up. What does a put buyer think? We'll come to that after the call option. So these are two different actions, M. Chandra. Hold on. Shashank, please do not write. I did not ask you. I know you know these things. I am explaining the others. Okay, let's agree not to preempt. If you're going to preempt, I will give you 5 minutes in the end. That time you can preempt what I'm going to teach after lunch. M. Chandra, there is sell call and buy put are two different actions. They might create a similar position that is bullish. They will create similar bullish positions, but they are two different actions. Got it? Yes, Ramesh. The strike price is 1.5 CR in our example. Absolutely right. All right, Shashank. No problem. Chandra, is it clear? Yes, absolutely correct. The purpose for both are buying of a call option, by selling of a call option or buying of a put option, both create bearish positions, but based on the market conditions you will decide whether you want to be a buyer of a call option or seller of a put option. Now let me first complete what is a call option, what is a put option, then all this what you are asking me will already be clear to you. Unless and until you don't let me finish what I have to teach you, how will you know? There are slides. Okay, I'll show you the slides. Let's directly go to those slides. Okay, let's just do it. Let's do this. We'll skip those slides and go here. Because you all know everything else, right? Let's just straight away start from this slide. Okay, buying a positively correlated call option is bullish. If you have to stick to the flow, you have to stick to your questions, which are to the topic. So why you are comparing? Why did you get put option in between when I am teaching you call option? And here I am not the loser. You are going to lose. Because everybody is just going ahead. One step, one step, one step. I want to know call put together. Alright. So call options, you can either be a buyer of a call option or sell. I know you guys are novices, Rajiv, but then your questions are not relevant to what your knowledge is. I will give you enough time to ask questions. Let us complete a section. Then you, if you don't understand that section, you have the right to ask me those questions. When I'm not even gone to the third sentence, you are asking me about put options. What is the reason? पहले कॉल को समझ लो, पुट अपने आप समझ में आएगा. All right, just hold on. Now call options. Sushila, this is not a retake class. You are mistaken. I've already mentioned this is a fresh plus retake class. So you can buy a call option or sell a call option, and whether you want to be a buyer or a seller depends upon your market view. Buy is to call away shares from the call seller. Sell call options is shares to be called away by the buyer. So earlier it was going to be a retake class, but then there was too much demand from freshers. That's why they changed it. Even I thought it is going to be a retake class. I personally do not prefer to take a fresh class online. I only prefer to take a retake class online. But that's my personal choice. Anyways, let's go ahead. So what does a call option give you? When you buy a call option, it gives you the right to buy a fixed number of underlying securities at a specific price on or before the expiration date. Calls rise when the underlying rises and calls fall when the underlying falls. Calls are positively correlated to the underlying asset class. Got it? Now, only related to call option, do you have any questions from this slide? Please let me know. I'll give you time to ask me questions related to only call options. Calls are positively correlated with the underlying, which means, remember Arun, the palm exercise, underlying goes up, call premium goes up. Underlying goes up, call premium goes down. Is that clear, Arun? That is what is positive correlation. Anand says, sir, first point, call away means I will call away the shares from your pocket. That's why it's called a call. I'm going to give you a call. Please send me my shares. Here's your money. That's why it's called a call option. It's just a name. Let's go to the put options. You can either be a buyer of a put option or seller of a put option. Buy of a put option to put shares into the hands of a seller. So you can put it into the hands of a put seller. Yeah, call is like buying of the underlying. So you have the right but not the obligation to sell the underlying stock. So if you buy a put option, what does the put option give you? Put option gives you the right to sell the underlying stock. You have the right, remember. So once you have the right, you won't have the obligation. So you can either have the right or the obligation. Got it? You can either have the right to buy the underlying or either to sell the underlying when you buy a put option, and when you sell a put option you will be obligated to buy the underlying. The right to sell a fixed number of underlying securities at a specific price on or before the expiration date. So for example, if you own the 300 put option of ITC lot size is 2500 and you owned one lot of put option. So what you can do is, once you buy the put option of ITC, you have the right to sell 2500 of the underlying securities at a specific price. What is the specific price? 300 on or before the expiry. That is the last date till which the option will be traded. Is that clear, guys? Put option. Put rises when the underlying drops. Remember the two palms. Left palm is the underlying, right palm is the put option. If the left palm goes up, right palm will come down. That is negative correlation. If the left palm goes down, right palm will go up. That is what is negative correlation. Clear, everyone? Perfect. Now, four basic positions that you can have. You can either be a buyer of a call option, or you can be a seller of a call option, or you can be a buyer of a put option, or be a seller of a put option. Now, what I want you guys to do is just go through this table and then tell me whether you have understood what that table is. So when you buy a call option, you are also said to be long that call option. If you buy a put option, you're also said to be long that put option. If you sell a call option, you're said to be short that call option. If you sell a put option, you're said to be short that put option. Buying of a call option is the right to buy what? The underlying. Buying of a put option is the right to sell what? Again, the underlying. Seller of a call option has the obligation to sell the underlying. Seller of a put option has the obligation to buy the underlying. Does it make sense now? So, any questions on this? At least this. Right now, I have not spoken about how to create a bullish, bearish position. Can we use call, put, call, whatever. We will talk about it in the slides that are coming up next. All right. So, couple of minutes because it's lunch time now. It's 1 o'clock. In the flat example, Shashank is selling the call option. So Shashank has the obligation to sell the flat. Yes, Deepa. Right means what? So when you buy an option, are you paying a premium, Pranab? Sorry, Pudupet? When you buy a call option, do you pay premium or receive premium? You pay premium, right? So whenever you pay premium, right, you have the right. You can decide when to buy, when not to buy. But when you receive premium, that is, so simple example, you are the person who has insured yourself. So you will stake a claim only when you want, right? Or just because you feel like staking a claim, can you stake the claim? So when you stake the claim under certain circumstances, the option seller will be obligated. He cannot refuse you if everything is as per the contract. He just cannot refuse you. He has to give that to you. That is obligation. Compulsion. You can't correlate the flat example with puts, Rahul. I'll have to take stock example. I'll take stock example. That's why I took the ITC stock example. Yes, Ramesh, we have to decide whether we want to buy a call or a put, and even if you have to sell, whether we have to sell a call or a put. You have to decide that. Obligation means receives premium. Absolutely. So when you receive premium, so the insurance company is obligated to give you the claim. If ITC not in the list means what, Suresh? Correct, Prasanna. You're right. Yes, Amit Kumar, you can. That is what you're going to learn in this 5 days, how to do that. ITC is not part of that. So they will be cash settled, Mr. Suresh. They will be settled in cash, not in stocks. Yes, Deepa, whether to buy or sell option and everything depends on the underlying. What is the underlying doing? If the underlying is bullish, you would either be a buyer of a call option or seller of a put option. If underlying is bearish, you will be either be a buyer of a put option or seller of a call option. When to decide to buy a call option or a put option, that will come tomorrow, not today. The seller will pay just the money, Mr. Suresh. He will settle it in cash. Yes, that means whatever difference is, 10 रुपए का profit है तो 10 रुपए into number of shares you own, that will get credited into your account. No, Parth. These are the four basic positions that we have. Using these four basic positions, you will create about 20 more positions. Total 20 positions. All right. Any other questions before we break for lunch? Yes, sir. Why you are so worried, Ramesh ji? Whether we can grasp, we can grasp. Did you grasp core strategy or no? Tell me. What 20 positions? Arey sir, don't worry, don't worry. That you leave it to me. मेरे पास भी थोड़ा skill है. Don't underestimate my skill. You can underestimate yourself, but don't underestimate me. I'll make sure you understand everything. That's a promise. Can we go back slides once we are offline? I didn't get your question, Bhavya. Whenever you call me, I'll come to Bangalore, yaar. I mean, you want to go back, Bhavya? Okay. You have any question? Yeah, so options will be little, but even when you're offline, you have, Bhavya, you must be having these slides as ebook, right? This is a PPT file. Once you log off, this my slide won't be accessible to you. Okay, but the same slides are there as ebook, either printed book or ebook. All right, so let all of you log off. All of you log off. All right. Hey, Pulwama terrorist died then and there itself. The guy who blew himself. Okay, the mastermind, no problem. Fine. All right, guys, please log off and join in back at 1 o'clock.